Getting started with investing can be very intimidating. There's stocks, ETFs, options, and futures, all of which are very complicated. But by the end of this video, you will know exactly what an ETF is, why you should own ETFs, what to look for when you're buying an ETF, and the difference between stocks and ETFs. I personally invest in ETFs. As you can see here, over 65% of my portfolio are in ETFs. The two main ETFs that I buy are Vanguard's VOO and Charles Schwab's SCHD. So let's answer that main question that you probably have. What exactly is an ETF? ETF stands for Exchange Traded Fund. Most of these funds will mimic an index fund such as the Standard & Poor's 500 index, most commonly known as the S&P 500. This holds the top 500 largest companies that are traded on the US stock exchange. ETFs that track the S&P 500 are usually traded at a fraction of the price. For example, the S&P 500 is currently trading at about $5,700 per share versus VOO and S&P 500 index is trading at just over $520. When you think of an ETF, you should think of a picnic basket, as a picnic basket holds all of your food that you will eat. An ETF holds all of the companies that you're investing in. So if you buy one share of VOO, you now own a small portion of the top 500 largest companies on the US stock exchange. And that brings us to the second point. Why should you buy ETFs? The first and main reason you should consider buying ETFs is because they will keep you well diversified, because each ETF will hold a wide variety of stocks and you won't have all of your eggs in one basket, even though you are only holding one or two ETFs. If you held onto shares of Apple and they dropped 5%, you'd lose 5% of your overall value. But if you owned VOO, which owns Apple, and Apple went down 5%, there still is a chance that you could be making money because there's still over 499 more companies that could be going up in value. The second reason is automatic rebalancing. When you invest in ETFs, they're typically managed, which means that they are updated without you needing to do anything. When a new company gets added to the S&P 500 index, your ETF will automatically add that company so that you don't have to do anything to keep that balance. Final reason that you should consider buying ETFs, especially if you're new to investing, is that they are very simple. You don't need to do a ton of research into individual stocks to see if they're a good fit for your investing style, or do the same research for 10 or more stocks. With ETFs, you should still do your own research, so here are a few things that you should look for when you're looking to buy your first ETF. There are a couple of things that are really important when picking out your ETF that you want to invest in. The most important, in my opinion, is the expense ratio. The expense ratio is the fee that is charged for you to own that ETF. To find the expense ratio, you can look on websites like Yahoo Finance and scroll down to where you see the overall statistics. Here you can see the expense ratio for VOO is only 0.03% per year. This expense ratio is paid for that rebalancing of the ETF and the overall asset management. The reason the expense ratio is so important is because you will be charged that fee no matter what. If the market goes up 10%, you still have to pay the fee. And if it goes down 10%, you still have to pay the fee, even though that pushes your losses even further. The whole idea behind investing is to increase your overall net worth, so why would you be paying these extreme fees when there's such low fee options out there? This is a super easy way for you to find the expense ratio for whatever ETF you're looking at. We're here on Yahoo Finance and we're looking at ticker symbol VOO. If we scroll down, we can look at all of the different statistics that are related to this ETF, such as the dividend yield and the beta, which just shows how volatile the stock or ETF is. We can look down here and we'll see the expense ratio, and we'll see that for VOO, it is indeed 0.03%, which means you'll be paying $3 in fees for every $10,000 that you have invested, which isn't that terrible. Now let's go take a look at SCHD. This is Charles Schwab's high dividend equity, and this has an expense ratio at 0.06%, which means you'll be paying $6 for every $10,000 that you have invested. Next thing you should look for in your ETF is the overall underlying equity. Like I said, the ETFs typically will track an index fund such as the S&P 500 or the NASDAQ. You should pick an ETF that falls in line with your risk tolerance. If you don't want to see huge losses in your account, you probably shouldn't buy an ETF that has a lot of risk like SQQQ. You should look into an ETF like VOO, but if that doesn't fit your risk tolerance, then maybe you can take on something a little riskier like VTI. There are hundreds of ETFs out there, and finding the right one can be tough. I do think that choosing an ETF with a well-known and solid reputation is very important. That's why you'll keep hearing me throughout all my videos say ETF names like VOO, SCHD, VTI, and SPLG. These are all very respectable exchange-traded funds, and I own all four of them. We're here on Snowball Analytics, and as you can see, my portfolio is just under $36,000. And if we look right here, we'll see that the funds or ETFs that I hold make up a whopping 66.11% of my overall portfolio. And I just want to show you that I do invest in what I'm talking about, which VOO makes up over $20,000 worth of my portfolio. Then I have VTI, which makes up a little bit less, and then Charles Schwab's SCHD, I have about 10 and a half shares, and then SPLG, another S&P 500 ETF. Just want to show you that I do invest in some of these companies or ETFs that I have been talking about. I'm sure that you noticed earlier that I also own some stocks in my portfolio, and that leads us to the final section of the video. What is the difference between stocks and ETFs, and which should you pick? As we discussed earlier, an ETF holds a wide range of stocks that make up the overall index, but a stock represents a fractional ownership of the company. When you purchase one share of Apple, you own a very small portion of Apple as an overall company, and you are entitled to a small portion of the overall profits that the company makes. This is paid to you in the form of a dividend. Some companies pay higher dividends than others, and if a company does not pay a dividend yield, that's because they're choosing to reinvest their profits back into the company to keep it growing, and this usually is reflected in a higher growth in the overall share price. If you like the idea of dividends and passive income, you may want to look into more dividend ETFs or dividend stocks. As you can see right here, I do own quite a few, and that gets me a total of $903.87 in passive income over the next 12 months. A stock usually differs from an ETF in the fact that you typically take on more risk. There's risk involved with both, but when you're relying on one company doing well versus 500 companies doing well, it is going to be a little bit more risky. Now that you know what an ETF is and why you should be buying them, you should also know that over long periods of time, these are expected to increase in overall value, making it so that you increase your net worth as long as you continue to keep buying more and more of these ETFs and stocks if you've decided to own some of these in your portfolio. If you found this video to be helpful, make sure to click the subscribe button, and if you want to see the top 3 ETFs that I would invest in, go ahead and check out this video.